I'm Amy, Head of Learning and Development and Support at Rate.
Morning, everybody. Thank you for joining us this morning. This morning training session is going to be done by our Chief Operating Officer, which is Rahil. And Rahil has got a huge financial background. So he speaks of a platform of knowledge and well-versed in the analysis of financial statements. And it is our privilege to listen to him this morning on a very good and topic close to our hearts, and that is financial ratios. Why? Because financial ratios plays quite a significant role in the lives of credit fraternity when it comes to knowing the financial capabilities and stabilities of your client. So without any further ado, and we do not want to waste time, if you have questions, please pop them into the chat or raise your hand, and I'm sure Rahil will also give opportunity for questions. And if there is questions that you would like to ask afterwards, please do feel free, contact us, and we will sit down with you and chat with you at any time. But thank you very much, Rahil. Welcome to the team again. You're an old trainer or guest speaker with us already. You've been here a few times. Floor is yours. Thank you very much.
Thank you, Martin, and welcome to all of our attendees. It's a full house today. I've had a lot of excitement putting together this session after the last one that we did on how to read financials. And so, I mean, everyone's taken me back 15 years to the time that I was at university doing all of the ratios. And hopefully all of this is still relevant. And we're going to learn some cool stuff during the course of the next 45 minutes. So thank you to Martin. Thank you to our attendees. So guys, what are we discussing today? We're going to be talking about financial ratios that every credit professional must know. Okay, I have left some time at the end for questions. We'll also make the presentation available to all of those that have attended. And hopefully by the end of it, there would be one or two things that come out of this that either we haven't known or things that was locked in the back of our minds for a good couple of years that will make us be better credit professionals. So without further ado, let's get right into it. So what is credit risk? Well, credit risk is all about predicting behavior. I need to be able to understand if I loan this person money, if I sell them goods on terms, will they pay me back? And that is what credit risk is all about. So when we talk about credit risk, what we're going to be focusing on today is particularly financial ratios, those that you get from annual financial statements. And we know that that's a topic of conversation recently. And what are these important financial ratios? And a little bit at the end is how is TradeShield going to be helping you, and how are we currently helping you do this? So what are financials? Well, financials are a historical snapshot of the trading position and the trading behavior of a business. Okay, so whilst your financials are historical, your credit decisions, importantly, are forward-looking. Every time I make a decision to sell on credit to someone, to extend terms to someone, I am making a forward-looking decision, which is, am I going to sell on credit to this guy? And is he going to pay me back? Okay, and so what are ratios? Ratios are the early warning signals, and one of the early warning signals that you would get from financial statements. So let's get into it. So where does trade credit go wrong? It's the over-reliance on any one financial indicator. If you look at one number in isolation, you're probably not going to have the full context. It's, like I said, also, it's looking at numbers in isolation. And then lastly, it's missing the early warning signs. When you put all of this together, it gives you a pretty good picture to the trading behavior, both past, present, and likely future of any debtor in your book. So what are the types of ratios we're going to be focusing on today? We're going to be focusing on four main types of ratios. And those ratios are liquidity ratios, which speaks to can they pay now? Solvency ratios, can this business or will this business survive? Profitability ratios, are they making money? And efficiency ratios, how well do they operate? So those are the four main classes of ratios, I'll call it, that we're going to be looking at today. And they each speak to different parts of a business. I mean, let's jump right into it. With liquidity ratios, the two main liquidity ratios, and now guys, with any of the ratios that we speak of course, these aren't the only ratios. There's a whole range of ratios that you can go and look at. And depending on the type of business you are, depending on the type of business your customer is, I mean, those could change. But what we're going to be focusing on is the most important ratios, okay? Liquidity ratios, there's two important ones that we're going to be looking at today. And these should be well known to everyone that has dealt with financial statements or done calculations on financial statements. It's your current ratio and it's your quick ratio. Okay. Your current ratio. What is your current ratio? Well, quite simply, it's the ability of a company to pay its short-term obligation using its short-term assets. Now, one of the four important statements in your annual financial statements is your balance sheet, or now it's currently known as your statement of financial position. And remember, this is the snapshot at the end of the financial year of the business, what the business has and what the business owes. Okay, so how do you calculate your current ratio? Well, it's a very simple calculation. It's your current assets on your balance sheet divided by your current liabilities. So what's your current assets? Those are things like cash and cash equivalents. It's things like inventory. It's things like trade receivables, i.e. the company's debtors. What are your current liabilities? It's your short-term obligations. It's things such as your trade payables, okay? Which importantly, if you're granting credit, you're going to be sitting in that next year for that particular customer. It's your tax. It's your short-term loans. It's your overdraft. It's all of the current liabilities that you have to pay in the short term, i.e. in the next few months or within the next financial year. Now, why is this important? It's important because it talks about how a company can satisfy its short-term obligations with what it already has as short-term assets, i.e. they don't need to go and borrow more and they don't need to go and get additional funding. So what are healthy ranges, right? Anything above 1.5 is generally considered healthy, but anything above 2.5, I mean, I would ask a question: why do you have so much cash lying around? Are you not utilizing your assets well enough? Maybe you've got an influx of funding that I need to be aware of. But basically, if you have a company that's sitting between the 1.5 to 2.5 range, that is considered healthy. Why? They've got a good ability to cover short-term debts, such as trade credit, such as your account, and they'd be able to cover that. Anything between 1 and 1.5 is cautious. I mean, that generally speaks to they don't have a very thick liquidity buffer, and they could be vulnerable to cash flow pressure. And anything below 1 could be a red flag. Now, why do I say could be? Because depending on the industry that they operate in, these could vary. So, for example, in the FMCG space, it's quite common that their current ratios may be a little bit lower. And the reason for that is because they turn over their stock a lot quicker. And in a manufacturing industry, for example, it's quite possible that this could be much higher. Why? Because they've manufactured very expensive machines, and that's sitting on their assets, and they haven't yet sold it, and therefore their current assets sits quite high. But basically, these are what's considered healthy ranges, and one of the things that could point to how they're able to pay their short-term obligations. But the main question that we're trying to solve for with the current ratio is, well, can they pay me in the next 30 to 60 days? The second of the liquidity ratios we're going to speak about is the quick ratio. Now, this one's a little bit more interesting because it's a stricter liquidity ratio. And this measures the company's ability to meet its short-term obligations. Okay, again, the same as the previous definition. However, this is using its most liquid assets. It's assets that's immediately available. So it's generally their current assets less their inventory. Why? Because if I've got stock on hand, I still need to sell that stock before I can generate cash from it. And so if I look at my quick ratio and without the inventory, it speaks to my trade receivables, i.e. cash that I'm going to collect very soon. And most importantly, my cash that I already have at hand. And this naturally would be lower because it takes out inventory from the calculation. But again, anything above 1.5, very strong. Anything between 1 and 1.5 is healthy. Between 0.8 and 1, cautious. There could be a tight liquidity and therefore limited buffer. But again, if we talk about fast-moving consumer goods, the likes of ShopRite, the likes of Pick and Pay, the likes of the big traders, you would generally find that their quick ratios are lower. And the reason for that is a lot of their assets that they keep on hand are stock that they're going to sell in the next couple of days, the next couple of weeks. But anything below 0.8 and definitely below 0.5, I would consider that a red flag because they've got a very heavy reliance on selling that inventory to be able to meet their short-term obligations. And so the question that we're answering with this is, do they rely on the sale of stock to pay me? So for example, what would I expect to see? I'd expect to see in an FMCG business that sells a lot of groceries, I'd expect to see fairly high current ratio and a fairly lower quick ratio because I know that they will sit with a lot of stock. But in a service business, for example, I wouldn't see much of a difference between current ratio and quick ratio because they're not selling stock. And so if I see a low current ratio and a low quick ratio, those are red flags for me to dig a little bit deeper. So those are your liquidity ratios. And again, what do they speak to? They speak to, can they pay me now or on time? Okay. Moving on to the second class of ratios. And if anyone has any questions, there will be a section for questions at the end. So feel free to already drop them in the chat, note them down, and we'll happily take them towards the end. The second type of ratios are solvency ratios. And what do solvency ratios speak about? Will this business survive? Do they have enough, as a business in their long-term assets, in their long-term funding to be able to survive? And that is the question that your solvency ratios speak to. And so TradeShield, for example, we've got two main risk models, and they're underpinned by a lot of different models in the back end. The one speaks about payment risk, which speaks about, will this debtor pay me within terms? I've given them a 30-day account. Are they likely to pay me within those terms? And that speaks to the previous section that we spoke of, which was liquidity ratios. Our second risk category that we have at TradeShield is our default risk. The likelihood of this going into protracted default, i.e., what's the likelihood that this could result in bad debt? And that speaks to the solvency ratios. So TradeShield is doing all of this in the background for you, various methods, various mechanisms, but these are some of the questions that we're already answering for you. So what are some of the solvency ratios? Well, there's two main ones we're going to look at. The one is debt to equity. We're going to get into that one shortly. And another one that's always interesting, and maybe not so much for trade credit, B2B trade credit, this is more that the banks look at and long-term funders, it's interest coverage. And we're going to look at both of these in the next few slides. So the first one, very important, it speaks about, you'll hear the term quite often, the gearing of a business, or the leveraging of a business. And it's basically how much of a company is funded by debt versus external debt versus shareholders' equity or generated profits. And the simple formula for this is your total debt, i.e. your total liabilities divided by your total equity, and that will give you a ratio. Now, any company that's at greater than 2.5 is a highly leveraged or a highly geared business. It means they rely for every 1 rand of funding that's already been made available by the shareholders or by its own profits, 2.5 rands, 2.50 rand, they rely on as external funding, i.e. from banks, from overdraft, from you, as in you supplying them a stock on trade credit. And so that's a highly geared business, and that's a high risk. Your elevated risk is between 1 rand, 1.5 and 2.5. Again, for every 1 rand that they have, they rely on 1.50 rand to 2.50 rand of external funding. and there's more reliance on debt, monitor them closely. Anything between the ranges of 0.5 and 1.5 is considered healthy, and anything less than 0.5, it's a low-risk business. They're conservatively funded. They're a business that's generated strong profits over a period of time, which have retained in the business, and they've got a strong buffer that has been created either by the shareholders or internally by the business. And so the main question we're trying to answer is, do they rely on external debt, which you would be one of them, to fund their business? The next solvency ratio we'll speak about is interest coverage. Like I said, not necessarily as important from a trade credit perspective, but always a good indicator, especially when we combine this with the next set of ratios, which we're going to look at, which are the profitability ratios. It basically measures how a company can service the interest on its debt from its own generated operating profits. Why? Any business needs to be able to sustain itself and needs to be able to generate its own profits in order for it to be a sustainable business. And yes, granted, some businesses will be in various stages of you get startups, which you know that there'd be a business that would be burning a lot of cash and therefore not have the profitability ratios that you would expect of a business that has been established for 15, 20, 25 years. Okay, and so this is quite, there's EBIT. Now, this is a term that you would get from the income statement. So this is an income statement ratio, which is your earnings before interest and taxation, and that divided by interest expense. Why? I want to know how much they've earned before they've paid any interest, before they've paid any tax, and that's relative to the interest expense. And anything above 6 is very strong. What does it mean? Let's take an example. If a company has got 100,000 Rand interest expense in a year, and their earnings before interest and tax is 600,000, well, they can afford to pay that interest expense 6 times over. So that's very strong. There's a low default risk from a debt servicing perspective. Anything between 3 to 6 is healthy. Between 1.5 and 3 is cautious. Anything below 1.5, it says low risk. It should be high risk, actually. Sorry. And that should be high risk. It's because they're struggling to cover their interest. They've got a very limited buffer. And if they default on one of their long-term obligations, i.e. what they owe to a bank, it's only a matter of time before they're going to start defaulting on the smaller accounts, i.e. your own accounts, when they don't have enough to cover those. So interest coverage, whilst not the most important trade credit metric, in my opinion, and Martin, you may disagree with me, still quite important, I think, for you to understand how a business is able to service all of its debts so that you have the full picture of a business. Martin, before I move on, we've spoken through the first 2 sections. Do you want to add anything?
Yes, it gives us some idea as to how much of our capital is bounded up in interest that needs to be paid. And it's also then important to read some notes to say, are some of the loans that we have, are they non-interest bearing loans or are they interest bearing loans? But a very good question that I had the other day, and I'm just popping that one in here. Someone said, what must I look at? If someone's got lots of cash in the bank, or they've got a huge amount of debtors, or they've got high liabilities, and that's what you said just now. Don't look at just one thing at a point in time and say this is bad or this is good. And that's what the ratio does. It takes things into a group, and it takes things into a group, and it says, let this group compare itself with this group and give you an answer whether or not the company can meet its obligations or not meet its obligations. Don't look at it at one thing, because there's other things in that group of current assets or current liabilities that can influence it. I mean, you know, and I know at financial year ends, the companies phone their creditors and say, listen, I'm going to pay you in 3 days' time. Why? They want to show the cash in their bank. So now they've got to use volume of cash in their current assets, and their current liabilities look high because they haven't paid their creditors. But 3 days after year end, that of course now takes care of one another. But the ratio looks at both and say, I've got assets here and I've got liabilities here, and if I equalize these two, then I have an answer as to what the company's capabilities are. Thank you, Rahil. Please continue, otherwise we can run out of time.
Excellent point, Martin.
Rahil, just before we continue, there is a question in the chat. It says debt to equity, right? Is it not better to look at net tangible equity, like removing goodwill, etc., to have a true picture? That's the question.
Yeah, it's a very valid point. Absolutely, debt to equity is useful, but it can sometimes overstate the strength of a balance sheet, especially when equity includes large intangible assets like goodwill. So by using net tangible equity, i.e., removing goodwill and other intangibles, you would get a much more realistic and conservative view of what's actually happening. But from a credit perspective, that's important because intangibles, it can't be easily liquidated. So when you've got a large amount of goodwill sitting, you can't really turn that into liquidity quite quickly. So it offers very little protection. But absolutely, but for the purposes of this session, I wanted to keep it a little bit simpler. But when we look at later on what we're doing with our Moody's integration and with our financial analysis report, I'm going to speak about this a little later on, you'd see that is taken into consideration. So, Mtungwa, great question. You're spot on, you're 100% right. But for the purposes of keeping it relatively simple, I just wanted to focus on overall debt to equity.
Perfect. Thank you, Rahil.
Great. We'll move on to the third, and in my opinion, one of the more important ones is your profitability ratios. And we're going to be looking at two of them. One, and both of these come from your income statement or your statement of comprehensive income, the modern word for it, terminology for it. And we're going to look at revenue growth and profit margins. Now, what is revenue growth? It's the rate at which a company's sales are increasing or decreasing over a period of time. What is my revenue this year compared to last year? What is my revenue this year compared to 3 years ago? Okay, so you look at how much your revenue has increased, so your current period revenue minus your prior period revenue, and you divide that by your prior period revenue. And again, this depends on the type of industry that you're in. But generally, if a company is growing by more than 30% year on year, that's very, very strong growth. Strong growth, but it can also create scaling demands. 15 to 30% is again strong growth, it's positive momentum, but monitor working capital. 5 to 15%, particularly in the FMCG space. We've looked at Shoprite's financials previously, the Shoprite group, and they're growing by about 10, 11% year on year, which is fantastic from all of the big grocers. They're by far growing the quickest in terms of revenue growth, and that's a great number. And then you're looking at, as long as it's above CPI, it means that they're growing faster than inflation in the country is growing. Once you start getting still positive, but lower than CPI, there is limited growth in the business. And when it's below CPI, you always ask the question, I can see you're growing, but you're not growing as fast as CPI, as fast as the general country is growing. And any negative growth, that's a shrinking business. And there's a high probability of cash flow pressure that we need to be aware of. And so, the question we're trying to answer here from revenue growth is this business growing? And a growing business is a business that will buy more. It's a business that should be able to generate more profits. It's a business that would be able to service its debt a lot more easily. Now, there are macroeconomic impacts that may happen, or conditions that may happen. For example, COVID. We saw during COVID, revenue CPI was negative. We went into a recession. Companies' revenues, particularly if you were in the alcohol, the cigarette industry, the restaurant industry, their revenues were almost wiped out overnight for a good couple of months. That is a macroeconomic external factor, which, yes, you have to bear in mind. But I wouldn't penalize a business as much based on that, because the entire economy, went through a period of strife. But now that we're post that, and what's very important is we've got at least 3 years post that. We've got 2025 financials, 2024 financials, 2023 financials, which is at least 3 years post the end of lockdown. You should be able to see a trend of a business, and a growing business is a good business. Okay, which leads to the next point is you can grow your top line revenue, and we see this very often, but you could make less money, less profit. And this is where your revenue growth coupled with your profit margins, both your gross and your net profit margins, and this speaks to how much profit a company makes. Now, very common question that we get, well, what's the difference between your gross profit margin and your net profit margin? Well, your gross profit margin is after your direct cost of sales. So, for example, if you're a business that sells goods, okay, so I buy this mouse for 80 Rand, I sell it for 100 Rand, my revenue is 100 Rand, my cost of sales is 80 Rand, my gross profit's 20 Rand, and therefore my gross profit margin is 20%. Or you could be a service business, and a service business, they would have much lower cost of sale and therefore much higher gross profit. But your net profit margin, every business, the long-term goal of a business would be to make a bottom line profit. Now, I do want to caution, when you talk about gross margins, it's heavily dependent on the industry. For example, in the FMCG space, again, the ShopRite, the Woolworths, the Pick n Pays, anything close to 10, 15%, 20%, 25% is considered healthy. Because why? They're purchasing goods, they're buying all of these groceries and they're selling it. And us as consumers, I mean, we wouldn't want them to add 100% markup on that. We wouldn't buy it. And so their markup is usually much smaller, anywhere between 3 to 8% on bread, on maize, etc., and a little bit higher maybe on not so critical groceries. In the manufacturing industry, 50% plus it's considered healthy. Why? It's because they're a high gross margin industry. A lot of their expenses would come from their operating expenses, i.e. their factory costs, their staff costs. And so therefore, whilst they may only post a net profit margin of 5%, their gross profit margin could well be 50% plus. And lastly, and I decided to add SaaS, which is TradeShield as a SaaS business. SaaS stands for software as a service. 75% plus is considered healthy. Why? We're largely a service-driven business, and a lot of our costs would be sitting within our operating expenses rather than in our purchasing to service the industry. And so what does your margin speak to? It speaks to, are you making money? i.e., are you making a profit? And this is why a company can have high revenue growth, but less profit, because maybe there's margin squeeze, maybe they've cut prices in order to get higher revenues. Similarly, a company could have less revenue than it had last year, but they've got more profits because they've decided they've entered a niche. They've got a specific product that no one else can, that you can't buy from anyone else, and therefore they can charge higher margins for it. They're happy to make less sales, but their profit margins are higher, and that is how you'd measure the two. So it's very important to understand which industry am I evaluating, because that determines what a good gross margin is, that you would consider. Okay. Lastly, and I know that there is a question, I'll come back to the question afterwards. There is the last of the main categories is efficiency ratios. Now it's very important. You always see trade debtors on a balance sheet, and you see trade payables, or trade receivables as it's called, and trade payables. And this can speak about how efficient the business is in collecting cash from its customers and paying that over to its suppliers. Okay, so there's a very common term that everyone in the credit industry would know is your DSO, which stands for your days sales outstanding. Okay, and that measures how long a company takes to collect cash from its customers. So if today is the 19th of March, if I sell you goods today on credit and I collect that on the 23rd of March, 4 days from now, my DSO on that invoice is 4. If I sell it to you on the 19th of March and I only collect that invoice on the 30th of April, my DSO is 41. And depending on what terms you issue to your customer, that's what your ideal DSO is. So if you as a business are issuing terms only on 30-day terms, your DSO, you'd want that to be as close to 30 days as possible. And yes, granted, depends on how you collect. Is it 30 days from the invoice? Is it 30 days from statement? It does impact that. And we can go into that in a different session. But this basically measures how long it takes a company to collect cash from its customers and how long a company takes to pay its suppliers. I found this when I was researching. Apparently, it's called DPO, Martin. I'm not sure if you're familiar with the term DPO, which is days payable outstanding. Not a very common term in our industry, but I think it is something that is that is mentioned. And why is this important? It's important because when a creditor's days, and how do you calculate it? Well, let's talk about that first. It's your trade receivables divided by your revenue times by 365. And that makes the assumption that you're making all of your sales or most of your sales on credit. If you're making a lot of sales on cash, it could skew the numbers a little bit. But remember, when we're looking at ratios, it's not always the exact ratio that matters. It's more the trend of a ratio that is important. And your DPO is your trade payables divided by your cost of sales times by 365 days. Now, why does this matter? Because a business that's got a better creditor days than a debtor days, it talks about a positive cash cycle. They're collecting their cash before paying their suppliers, okay? Which that's what businesses want to do. I want to collect my cash. Martin owes me cash. I want to collect my cash from Martin. I want to keep it for 1 or 2 days, and then I'm going to pay Neil. And that way, that's a positive cash cycle. If your debtor days and your creditor days are roughly equal, and I've never seen this, particularly at the big FMCG companies, their debtor days are usually around 30, 35, and their creditor days are anywhere close to 80. And we all know this. But if it's largely equal, it's neutral capital, and it's a balanced working capital position. Where it becomes very concerning, and why DSO, why is it important to you, who is going to sell on credit to a company, for you to know how they collect cash from their customers? Well, it's because if they take a long time to collect cash from their customers, they're not going to be able to generate that cash fast enough to pay you. And that is why when the debtor's days is much larger than your creditor's days, it could speak to a negative cash cycle, i.e. they're funding customers before getting paid, i.e. there's an increased reliance on supplier credit from you to manage and balance their books. And this is why this is one of the more important indicators in the annual financial statements that there are. Okay. So let's go back to the question that we had on hand. And the question was, does product and product strategy have negative revenue growth, especially consumer behavior have shifted? What about customer life cycle whereby we lose customers? Yes, absolutely. Negative revenue growth is often, particularly around the type of business, a product or customer problem and not just a financial problem. And I think there are a couple of drivers behind it. One, it's an external shift, i.e. if customer behavior shifts and the product doesn't evolve, then your demand drops. An example of what we can look at is we know that the tobacco industry is going through a very tough time, and largely driven by two main things. One is the sale of illicit cigarettes, okay? But the second, it's due to the e-cigarette, vaping, right? And so therefore there's been an external behavioral shift. A lot of people have given up smoking of cigarettes and they've moved to vaping and e-cigarettes. And so that's an external shift, okay? And that shows up as declining sales. And even if the business was previously strong, a business like that could still have declining sales. Okay? And what would they have to do? They'd have to reinvent themselves, get involved in that space, get a share of that pie to be able to bolster their revenues. The second, which is an internal issue, is your customer lifecycle and retention. Losing customers or low renewals or weak upsell, this directly impacts revenue and is often an early warning sign. So from a credit perspective, this matters because declining revenue means pressure on margins and cash flow, and it often precedes liquidity stress and payment delays. So when we see negative growth, the key question isn't just how much, it's why. Why? Is it a market shift, or is it an internal issue and that they're losing customers? We saw a couple of years ago, Pick and Pay went through a very tough time in which they were losing a lot of revenue, and their revenue numbers weren't nearly as strong as anyone else. We've seen a slight recovery over the past year, but they're still not in the same position as the ShopRites and the Woolworths are. And that is the question. So it's not just a number, but it's a signal that something deeper in the business model is either breaking or changing. Okay. All right. So how to think like a credit professional? One, don't look at ratios in isolation. Okay. And look at trends. Okay. And importantly, very importantly, compare to industry. Okay. The most important insight is cash flow in many, many, many instances is almost better than profit. Just because someone is showing a profit does not necessarily mean that they can meet their requirements. So showing a turnover of cash, a turnover of stock, is more important for you as a trade creditor than it is the fact that they're merely just profitable. Okay. And so just to come back and tie this all up is, what are the 5 red flags? 1, declining liquidity is always an issue. And so when you see a decline, a trend of decline, 1, that's a red flag. 2, rising DSO, their inability to collect their cash will at some point impact their ability to service their debt, i.e. pay you. 3, falling margins. Okay, falling margins means they're making less money, they're having to work harder for their money, and therefore that could put an impact on their business. 4, increasing leverage. They're not able to sustain themselves and they have to continuously increase their external borrowing. And lastly, they're generating a lot of profit, but they've got no cash. That is also a flag. I do see that there's a question from Shanaz. I will come back to that shortly. And to end, I mentioned at the beginning briefly how TradeShield is helping. Well, one of the new products that we're in the process of releasing very shortly in the next couple of weeks is, we've always been a Moody's partner, and we've always used Moody's Analytics on financials in the back end with our scoring mechanisms. However, what we're doing now is we've designed a new report which, when financial statements are provided, it does a couple of things. We've integrated Moody's probability of default scores and ratings. So I've intentionally left it a little bit vague from a picture perspective, because I want to speak to those of you that are interested a little bit more deeper about this. So Moody's, I mean, they're one of the worldwide global leaders in terms of risk scoring on financial analysis. And we have automated the ratio calculation and trend tracking. So down at the bottom, you can see wherever these ratios, and some of the ratios we've spoken about, plus a little bit more, we would automate the calculation and the trend tracking of that. Has it worsened? Has it improved? Which of them are red? Which of them are green? We've combined all of this financial analysis with our real payment behavior. And in the last 12 months alone, we've collected around 750 billion Rand worth of aging data. And that's total aging data, of which about 440 billion Rand was just current sales. And based on that, we track about 400,000 active companies. We're able to see not just how companies are performing from a financial perspective, but how they're actually paying in the market. And this is what enables proactive, forward-looking credit decisions. So this report's going to be out in a couple of weeks. If you're interested, if you're an existing customer and you're interested, please reach out to your account manager. We'd love to take you through it. If you're not an existing customer and this is something that seems of interest to you, please reach out to me or to anyone else, or go visit our website, and there's an ability for you to click a link and we'd get your details and we can have a discussion there. And then lastly, questions. So I do see that there is a question from Shanaz. So Shanaz's question is, loan receivables inflate the balance sheet. How should this be viewed? Yeah, so it's a good question. Okay, they do inflate the balance sheet. So how do we treat them with caution? It all comes down to, in my opinion, and Martin, maybe you can take this afterwards, is quality over size. Are the loans, firstly, are they internal? Are they loans to other group companies? And if they are to other group companies, then maybe you'd want to ask for the group financial statements to see how is the group doing as a whole. Okay. Are those loans performing or are they impaired? Okay, i.e., are they true reflection of what they're actually worth? Secondly, is how liquid are they? Are they going to convert into cash quite quickly? So maybe there's an internal loan that was made to a group company that is only going to be paid back in 5 years' time. Then yes, you would view that slightly different. Or maybe that loan is going to be paid within the next financial year. Then you can consider it quite liquid. And then what's the level of provisioning and expected losses? So if you read the notes to the financial statements, you would get some of that information. But in practice, we often adjust ratios or discount those assets because the focus should shift to cash generation and cash flow from cash generation activities, not on reported assets. And this is why it's so important that when you look at your quick ratio, for example, if those loans are sitting in your current assets, it means that there was a test done by the auditors that that is going to be repaid in the next financial year. And so that would be a good indication. But if it's a group loan that's not going to be paid back in the next financial year and is only 5 years due, that would sit likely in your non-current assets and will not form part of your current ratio and not form part of your quick ratio. And so, Shanaz, the question is, you do have to understand that a little bit more. If that is part of the current assets, then you would want some clarity around those loans just to understand if they're in a tight financial position. What does that mean from a liquidity perspective for the company? But even without those loans, they're quite liquid. They're able to meet their short-term obligations. Then I shouldn't see a problem with that.
Read the notes. Very important. Like when you assemble something, my wife always say, have you looked at the little booklet, how do you assemble this thing? So when you see a thing in your current assets and it's not clear to you as to what the loans are, go read the notes. Notes will tell you, are there any interest on those loans? Have they got a specific time to repay and all of that? But if it's in your current assets, it means it's going to have to be repaid in this financial year, and therefore it's putting a little strain on your calculation as well. And it, of course, depends on the value. And it's no problem in asking the question, going to the company and say, I see these loans, when are they going to be repaid? I see there's absolutely no time frame on it, but is there some idea as to when the business needs to? So a lot of times if a company is growing fast, or it's a new company that's growing fast, you'll see that the revenue and the cost of sales are doing this. They're running parallel with one another, and it's not something that goes like this. So the minute your cost of sales goes over your what's the name, then you know that it costs you more to make money. Then you've got a serious problem. But look at these things in conjunction with one another and understand what the two different things mean. So many times I've heard, yes, but look at how they're growing. Their revenue is almost triple. But what happens on their costs? So you have to look at how much it costs them to make that money. And then what is the margin? Is the margin staying constantly the same, or is the margin being put under pressure? Because as we all know, these larger organizations, they have got an animal called procurement. And when procurement walks into your space, they're going to say, we want to buy your product, but we want to buy it at this price. So they're putting you under pressure. You had a margin in your mind of this much. And then, of course, the minute you start talking margin, you start talking terms. You can't give 60-day terms with a margin smaller than 5 or 10%. Then you start looking at losing money and not making money. Your revenue might look good, but your profit's not going to. All those things needs to be looked at and considered when you're making a risk decision on financial statements. Any other questions, guys? Is there another question? I see there's a tag there on the clear. Thank you. Okay.
Good. Okay. So what I wanted to do, Martin, and I wanted to do a bit of a case study. And when I put together all of my notes, I realized that there wasn't time for a case study. But what Neil will do, and we're trying to get that sorted, is launch a poll. So we always poll. So if I get good results on the poll, you guys may see me back again. If I get bad results, and it's probably one of the last ones that Martin and teams are going to ask me to come and do. But if there is interest, then what I'd like to do as a follow-up in the next couple of weeks is to do a case study. We get some financials from well-known companies, and we do a case study of their ratios and an interpretation of that case study. What do the ratios tell us? So Neil, I know Neil's been trying to get a poll together. I'm going to get a poll out shortly. It's 2 simple questions. It's a 1 to 10 rating of how you found the session, and it's would you be interested in attending a follow-up session on a case study? We're going to get that shortly out to you now. And so,
Rahil, I see Sali's got a question there. He says, I have a customer currently that shows negative equity, made losses prior years. However, they have a letter of guarantee from their ultimate holding company who will be supporting them until they are back in a positive position. Now, firstly, qualify the letter of credit or the letter of guarantee is to understand the position of the holding company. Because your holding company might say, oh, don't worry, we will take care of their debt. But they're in a worse condition than what the subsidiary company is. then that letter of undertaking means absolutely zero to you. Understand the financial position that the company is that gives you this cross-company. It's called a cross-company guarantee or a holding company guarantee. You must understand the financial position of. So your risk is now shifting from your current debtor because you've now got this. And is there a specific period attached to that? They might say until they seem them to be good, what's going to happen to their guarantee? They might say it's for 5 years, or it's for 6 months, or it's for 12 months, or it is a blanket one, and they cannot cancel that guarantee until they've sat down with you and say, listen, we are going to now lift our guarantee. This is the new financial statements of this business. You can now see that they've turned themselves around. But be very careful before you release any securities or any promises or anything that is a support for you in granting credit to someone else. And also, the minute you start taking securities and stuff like that, it puts a different burden on your credit team because you've got to monitor those things as well. So always make sure you understand why it is that you want to grant credit to someone and what is the things that you're going to have to do. Now, I know I'm the one that always preaches by saying, look for a reason to grant credit rather than looking for a reason not to grant credit. But when I say look for a reason to grant credit, it must all be taken into consideration. I don't want to give you 100,000, but I'm prepared to give you 20,000. And let's see how we can grow you into that position. Please fill in your poll and let us go from there. And Rahil, let me put your mind at rest. You have been highly praised by our guests. They love the talks that you do, and it's very informative, and it helps them a lot in their day-to-day usage of risk evaluation. Any other questions? If not, we're going to close this meeting and we're going to give you 10 minutes of your own time back. Thank you once again, Rahil. It was highly informative.
That is a lot of clapping hands and hearts that I'm seeing there. Jeez, luck. That's a standing ovation, that. Well done.
Guys are making me blush. Thank you, Martin. Thank you, team. And thank you, most importantly, thank you for our guests that have joined us.
Thanks, everyone. We'll just keep the meeting going for the people that still need to complete the poll.
Yeah. And if there's any other questions that you didn't want to ask, you are more than welcome to pop it in the chat or email Neil or myself direct, and we will share it with Rahil and he will come back to you guys. And Rahil will share his slides. He will just make that one correction where it said low risk and it should be very high risk. And he'll share it with you guys, and you are more than welcome to use it to your own benefit.
Thanks, Martin.
Excellent. Thank you for that in-depth knowledge, Rahil. It's always really nice to dive into what we actually do in the background, considering ratios and these deeper questions of, is this a smart move to go with this company, and gearing ratios. It's very, very awesome to deep dive into this. So thank you again.
Thanks, Neil. All right. Thank you, everybody. Looking forward to the next one.
Bye, everyone. Thank you. I will just stay in for the poll. Martin, you're also welcome to jump if you want.
Yeah, almost done, Neil. So I'm sure once everybody's closed down, someone will still. They can't shut down and not do the poll. They got to do the poll because I see we've got quite a few people that have done the poll, which is 35. Yeah, there's 35 people that have done the poll.
Yeah, now that there's a little bit of people, I can put my camera on because I'm not distracting them from Rahil's session now.
At least you combed your hair, Neil. At least you
at least, eh? I just did a little.
Cheers, guys.
Cheers, guys. Have a lovely day.
Join us every Thursday from 10 to 11.